Imagine standing in a crowded market more than 1,000 years ago with 100 silver coins hidden beneath your robe. You have sold a season's worth of goods, and your family needs the money in a city hundreds of miles away. There is no wire transfer, postal money order, or standardized banking network spanning the route. No telephone, electronic identity check, or universal public guarantee protects an ordinary traveler. The obvious solution is to carry the coins yourself. But the road crosses mountains, deserts, toll gates, and territories controlled by men who may value your purse more than your life. Hiring guards costs money, feeding them costs more. Every extra horse advertises that something valuable is being protected. A storm can delay the journey, a border can close, a ship can sink, a dishonest agent can disappear. Even if the chest arrives, the coins may be clipped, debased, unfamiliar, or worth less in the destination market than they were at home. So you make a decision that appears impossible. You walk into a merchant's shop, place the silver on his table, and ask him to make its value appear in another city. He counts the coins, tests a few against a stone, weighs the pile, and writes an instruction. Days or weeks later, a second merchant in the distant city gives your family local silver. Yet the coins you surrendered never left the first shop. They may still be sitting in its strongbox. No treasure caravan carrying your original coins crossed the desert, and no chest containing them passed through customs. Instead, a message traveled and a promise was created. This was the central achievement of long-distance money transfer before the wire. People learned to separate value from the particular metal that had represented it. The customer believed he was sending money. In a physical sense, he was not. He was changing two local cash balances and creating a debt between intermediaries. One broker accepted coins here, another broker paid coins there. The road between them carried a message, while the financial obligation remained to be settled later. The money did not need to make the journey because the broker's relationship made the journey on its behalf. To understand why that mattered, begin with the cost of moving metal. A silver coin is compact compared with grain or cattle, but a large commercial payment is still heavy. 1,000 coins require containers, animals, guards, time, and secrecy. Protection can become a cruel economic calculation. Too little security invites theft. Too much security tells every observer that the cargo is worth attacking. The transporter also carries what economists now call concentration risk. If the entire payment is in one chest and that chest disappears, one accident destroys 100% of the transfer. Distance adds another problem. Coins are not automatically equal merely because rulers stamp faces on them. A merchant receiving foreign silver must ask how much pure metal it contains, whether it has been clipped around the edge, whether the issuing ruler has recently reduced its quality, and whether local buyers will accept it. The payment therefore arrives with inspection costs and exchange risk attached. A bag described as 100 coins may become 92 coins of usable value after weighing, testing, conversion, taxes, and fees. Transporting money is not just moving an object. It is moving an object whose identity, purity, legality, and price must be proved again at the destination. Now return to the two brokers. Call the first one Hassan and the second one Marco. They are a composite used to reveal the balance sheet logic, not a claim that one universal institution joined every region or followed identical rules. Hassan operates in an eastern trading city. Marco operates near a Mediterranean port. They deal repeatedly with merchants traveling in both directions. They may be relatives, partners, members of the same commercial community, or correspondents joined by years of successful business. Each maintains a pool of local cash and a book of claims against other people. You give Hassan 100 silver units. He deducts an agreed fee or builds his compensation into the exchange rate. He then sends Marco an authenticated instruction identifying the recipient and the amount to be paid in Marco's local currency. Marco does not wait for your coins. He pays your family from money already under his control. Perhaps he asks for a name, a phrase, a token, a witness, a sealed letter, or some combination suited to that time and place. The precise method varies, the economic structure does not. Hassan now has more cash, Marco has less cash, and Marco has acquired a claim against Hassan. Suppose your 100 units produce a payout worth 97 after fees and exchange. Hassan's strongbox rises by 100. Marco's strongbox falls by 97. Marco's ledger records that Hassan owes him. To the customer, the transfer is finished when the family receives the payment. To the brokers, it has only begun. They have created an unsettled position between themselves. That difference is the secret hidden inside almost every payment network, ancient or modern. Customer settlement can happen before intermediary settlement. Why would Marco release real silver in return for a distant promise? Because the promise is not isolated. It sits inside a repeated relationship. Marco may have paid for Hassan last month, while Hassan paid for Marco the month before that. Traders from Marco's city may soon ask him to send funds eastward. If so, Marco can accept their cash and instruct Hassan to make the eastern payouts. The two opposite flows cancel part of each other. Instead of shipping 100 units west and 80 units east, the brokers can offset the obligations and settle only the remaining 20. This is netting, and it changes the economics completely. Physical transport does not vanish from the world. Coins, bullion, goods, and valuable commodities still cross long distances. But the network reduces how much final settlement material must move. In a sufficiently balanced corridor, many customer transfers can be reduced to a much smaller residual position. In a strongly one-way corridor, however, far less can be offset and another settlement method is required. The dangerous road carries less treasure because ledgers have allowed opposite promises to meet before metal is dispatched. The residual debt can be settled in several ways. Hassan might eventually send silver, he might direct a trading partner to pay Marco, he might finance goods traveling west and allow their sale proceeds to satisfy the balance. Marco might owe another merchant who also owes Hassan, permitting a chain of debts to be compressed. A future transfer in the opposite direction might offset the position through ledger entries. Settlement could use cash or bank balances, goods or services, foreign assets, or transferred claims that ultimately reached a party able to offset them. Not every network used the same method, and not every corridor produced a small net balance. The achievement was reducing gross physical movements whenever matching claims made that possible. That transformation produces savings, but it does not produce safety for free. The physical risk of robbery is replaced by financial risk. Marco may pay your family and later discover that Hassan cannot settle. Hassan may die, flee, become insolvent, suffer confiscation, or simply deny the instruction. A messenger can alter a letter. A criminal can imitate a seal. A customer can claim that the rightful recipient was never paid. A currency can fall in value while the balance remains open. A war can separate the two cities. A ruler can forbid transfers or seize a broker's assets. The system does not eliminate risk. It changes the type of risk and assigns it to people who are better equipped to monitor it. That is why reputation became economic capital. A broker known to honor obligations could attract more customers, charge for reliability, and obtain credit from other brokers. A broker who defaulted might lose far more than one disputed payment. He could lose access to the entire network that made his business valuable. Relatives might refuse to deal with him. Partners could warn other markets. Merchants might stop accepting his letters. In a world without an instant central database, reputation was slow to build, easy to damage, and capable of traveling through commercial communities faster than formal court judgments. Family and community ties helped because they extended the consequences of dishonesty. If one agent vanished, his relatives or partners might face pressure to make good on the debt. Shared language, origin, religion, guild, or trading custom could make information easier to obtain, but none of these guaranteed virtue. The practical advantage was repeated contact. A network could observe conduct over time. It could limit new agents, demand collateral, reduce transaction size, refuse suspicious customers, or cut off a member whose behavior endangered everyone else. Liquidity mattered just as much as honesty. Marco could possess a perfectly valid claim against Hassan and still be unable to pay your family if his local strongbox was empty. The system therefore required local cash pools at both ends. A broker had to predict the direction and timing of transfers, keep enough reserves to meet payouts, and obtain emergency funds when flows became unbalanced. A harvest failure, pilgrimage season, military campaign, tax deadline, or migration wave could cause money to move heavily in one direction. Trust answered the question, will my partner eventually repay me? Liquidity answered the more urgent question, can I pay the customer today? This distinction explains why an apparently simple transfer business could be profitable. The broker provided more than delivery. He supplied local cash on demand, verified identities, converted currencies, absorbed timing differences, maintained correspondence, guarded records, and accepted the risk that another intermediary might fail. His revenue could appear as an explicit fee, a less favorable exchange rate, a commission embedded in a trade deal, or a combination of all three. A customer was not merely paying to move wealth. He was paying to avoid carrying it, defending it, testing it, and waiting for it. There was no single moment when humanity invented this idea. Different societies developed instruments suited to their governments, trade routes, legal traditions, and available forms of communication. Some arrangements were private and informal. Others used officials, temples, merchant houses, money changers, fairs, or state offices. Some documents functioned as payment orders. Others were certificates of deposit, credit instruments, or exchange contracts. Calling all of them checks, or wire transfers, would impose modern categories on institutions that worked differently. Yet they repeatedly solved the same problem. How can value be paid somewhere else without transporting the exact coins handed over here? Tang-era China offers one securely dated answer. By roughly 806, 820, tea traders who sold cargo in the imperial capital could deposit proceeds with representatives of their provincial administrations and receive flying cash certificates. Back in their provinces, the certificates could be redeemed for currency after taxes levied in the capital were deducted. Purchasing power could return home more easily than strings of metal coins. Flying cash was not a modern consumer bank transfer, and it should not be described as if every Chinese subject could tap an account and send an instant payment. Its administration, users, legal setting, and redemption rules belong to Tang China, but its economic logic is familiar. The merchant did not need to reverse his trade journey while guarding the same copper he had received in the capital. A document carried the claim. A designated office honored the certificate using funds available in the merchant's home province. The claim was limited to participating offices. It was not universally spendable paper money. Metal remained important, but the certificate allowed the merchant to leave the deposited copper behind and claim an equivalent payment elsewhere. Across the Abbasid world, a better documented instrument was the suftaja, attested in Arabic papyri by the 9th century and extensively evidenced later in Cairo Geniza records. One person paid money to an agent and received a written order. An affiliate in another place then paid the named recipient. Muslim jurists disputed some forms because avoiding the cost and danger of transporting money could be treated as a benefit obtained from a loan. Historical hawala often referred to transferring or assigning an existing debt, while modern informal hawala can assume several different legal and commercial forms. South Asian hundi developed its own changing forms. These were related solutions to remittance, credit, and settlement, not one unchanged machine bearing different names. When discussing modern hawala-style networks, the word informal can mislead listeners. It does not necessarily mean casual, unrecorded, illegal, or primitive. Some networks kept detailed books and enforced strict business customs. Some operated beside formal banks. Some used bank accounts during settlement. Some served places where formal institutions were expensive, distrusted, distant, or absent. Such systems could be used for legitimate family support, commerce, migration, and emergency payments. Like formal financial channels, they could also be abused. The mechanism itself is a way of transferring value. The legality of a particular transaction depends on the people, purpose, jurisdiction, reporting, and regulations surrounding it. Consider what the agents actually transfer across distance. Hassan does not transmit your particular silver to Marco. He sends an instruction and incurs a liability. Marco receives no part of that original coin pile. He relies on his relationship with Hassan and releases his own local funds. Later settlement may involve no cross-border cash at all if opposing obligations and trade payments cancel. The network therefore converts geographic distance into counterparty credit. A road problem becomes a balance sheet problem. A guard is replaced by due diligence. A treasure chest is replaced by a claim. The transformation is powerful because information weighs almost nothing compared with metal. But before electronic communication, information still had to travel. Letters went by courier, caravan, or ship. Messages could be delayed, intercepted, damaged, forged, or misunderstood. Networks responded with seals, duplicate instructions, distinctive handwriting, code words, witnesses, ledgers, trusted messengers, and confirmation procedures. Security depended on keeping the instruction verifiable without making it so obvious that anyone who stole it could collect the funds. There was always a tension between speed and certainty. Paying immediately pleased the customer, but exposed the distant broker if the message was false. Waiting for multiple confirmations reduced fraud, but weakened the reason to use the service. Larger payments might require stronger evidence or several correspondents. New customers could face limits. Known merchants obtained better terms because the network possessed information about them. Financial history repeatedly returns to this trade-off. Faster settlement makes money more useful, while finality requires institutions capable of absorbing the mistakes that speed can produce. Medieval and early modern European merchants developed another family of solutions around exchange contracts and bills of exchange. A merchant in one city could give money to a banker or merchant banker and receive an arrangement under which a correspondent in another city would pay a named person, commonly in another currency and at a later date. One classic description reduces the exchange to two places, two payments, and four people. The person paying in the first city, the person receiving there, the correspondent paying in the second city, and the final recipient. The bill did more than spare travelers from carrying coins. It joined payment, currency exchange, credit, and time. The rate between currencies could compensate the intermediaries and reflect risk. The interval before payment allowed commercial credit to exist inside the exchange transaction. Because obvious interest-bearing loans faced religious and legal restrictions in parts of medieval Europe, some profits could be expressed through exchange rather than called interest. But not every bill was a disguised loan, and not every exchange profit was fraudulent. Merchants genuinely needed to convert currencies and move purchasing power between markets. By the 16th century, exchange fairs such as Lyon, and later the fairs associated with Besançon and Piacenza, had become highly developed places where bills and account obligations converged. A merchant might arrive owing money on several bills while being owed money on several others. If every debt required a separate chest, the payment system would recreate the very transport problem the bills were meant to reduce. Instead, merchants compared claims, reassigned debts, extended short credit, and settled net positions. At these later exchange fairs, closely connected merchant bankers could clear large volumes of paper obligations while using much less coin for final balances. The moment a payment was refused exposed the machinery hidden by success. Imagine that the recipient presents a bill in Bruges on the appointed day and the correspondent says that no funds are available. The paper has reached the city, but payment has not become final. In many European bill markets, the holder can have the refusal recorded, often through a notary. This protest preserved evidence that the bill was presented on time and payment was denied. The claim could then travel backward through the chain to the drawer or earlier endorsers, depending on the contract and local custom. The document that carried value forward now carried liability backward. This procedure mattered because distance made excuses easy. A correspondent could claim the bill arrived late, a drawer could say it was never presented, an intermediary could blame a messenger or exchange rate dispute, a dated protest turned a private argument into evidence that a court or trading community could recognize. It did not guarantee recovery, but it made default visible. Authorities also knew that an exchange table could endanger more than its owner. Some towns supervised money changes, required sureties, prescribed records, inspected coins and weights, or punished fraudulent exchange. Merchant courts, notaries, and civic courts enforced different parts of the system. Rulers could also weaken it by banning transfers, seizing balances, altering coinage, or protecting politically valuable debtors. Regulation was both support and threat. It could strengthen a promise or suddenly prevent it from being honoured. The crucial product was not the elimination of failure. No institution could ensure that every broker remained honest, liquid, solvent, and politically protected. The product was a known path after failure, who could demand payment, whose assets could be pursued, which records counted as proof, and how quickly the network learned that a name was unsafe. A payment system becomes scalable not when promises stop breaking, but when broken promises can be identified, assigned, and contained. That is what allowed a merchant to trust paper across a distance where he would never trust an unknown man's word. The ledger was not valuable because ink possessed purchasing power. It was valuable because courts, customs, reputations, guarantors, correspondent relationships, and the expectation of future business made entries enforceable. A piece of paper from an unknown stranger could be worthless. The same paper, bearing a trusted name, accepted by a known correspondent, and embedded in a reliable market, could mobilize a fortune. Financial instruments scale only when the social and legal machinery supporting them scales too. Before the message moved by wire, the paper itself could travel. In 1864, the United States Post Office Department introduced domestic postal money orders. A sender prepaid the amount and a fee at an authorized post office, received a voucher worth no more than $30, and mailed that voucher to the recipient. The recipient presented it at a participating post office and exchanged it for cash. Only 141 offices initially issued the orders, but demand expanded the network, and foreign money orders followed in 1869. The postal money order was not instantaneous. A physical document still had to survive the journey. But the recipient no longer depended on the sender's personal credit, and the sender no longer had to place vulnerable coins or banknotes inside an envelope. Prepayment and postal records stood behind the promise. It represented the midpoint between the merchant letter and the electric transfer. The original cash stayed behind, but the payment instructions still traveled on paper. As networks expanded, the same feature that made them efficient made them fragile. Every claim depended on another balance sheet. If one important correspondent failed, people who had never met him could suffer losses. If rumors caused customers to demand cash simultaneously, a broker with valuable long-term claims might still run out of money today. If exchange rates moved sharply, a fee that looked profitable could become a loss. If rulers froze accounts or repudiated debts, private promises could collapse beneath political force. The transfer business therefore required invisible infrastructure. Agents needed capital, records needed reconciliation, errors needed correction, disputes needed a forum, currencies needed prices. Messages needed authentication, insolvent members needed to be isolated before their promises contaminated the network. Customers saw one simple act: pay here, receive there, but behind it stood a machine made of credit limits, reserves, exchange calculations, commercial intelligence, and repeated settlement. Then the telegraph changed the speed of the message. Western Union says it added its consumer money transfer service in 1871, using its telegraph network to coordinate distant payouts. A customer could pay an agent in one place, and an instruction could travel electrically to an authorized office elsewhere, where, after proving identity, the recipient received a negotiable draft that could be cashed locally. Once again, the customer's physical coins did not race through the wire. The destination office issued the payment draft, while company accounts and banking arrangements recorded and later reconciled what each office had received or dispersed. The wire did not replace the ancient economic logic. It accelerated it and placed more of it inside a large, standardized company. Telegraphy reduced the time required to send an instruction from days or weeks to minutes or hours. Standard procedures and authorized officers widened the circle of strangers who could use the service. Codes and operating rules helped control fraud. Fees paid for the network, staff, local cash, reconciliation, and the promise that an instruction accepted in one office would be honored in another. This is what a wire transfer originally revealed. Moving money is often an accounting event coordinated by communication. The wire carried an instruction, not a stack of gold. One office accepted local cash, another issued the payee a negotiable draft, and the company's internal books reconciled receipts and disbursements. The branches did not need to behave as two independent brokers with a private bilateral debt. Technology made the message astonishingly fast, but the transfer still depended on agents, liquidity, identity, records, and settlement. The same architecture appeared at a larger institutional scale. Beginning in 1915, the Federal Reserve used telegraph communications to transfer balances between reserve banks. In 1918, the system began leasing a dedicated telegraph network. The authenticated message changed ownership of balances already held on reserve bank books. The telegraph allowed settlement to become faster and safer without forcing currency to travel between every pair of institutions. Modern payment systems add computers, encryption, regulation, compliance checks, automated clearing, and enormous scale, but they preserve the separation between message and settlement. When you send money through a bank today, your particular notes do not leave a labeled compartment and travel to the recipient. Your account is debited. Another account is credited. Banks adjust claims against one another, use correspondent accounts, clearing systems, or central bank balances, and settle according to the rules of the payment rail. Sometimes settlement is immediate and final. Sometimes instructions are accumulated and netted. Sometimes an intermediary extends credit during the gap. Sometimes a payment appears complete to the customer, while institutions still have obligations to reconcile behind the screen. The language of sending is convenient because it describes the customer's experience. Economically, much of the system is coordinated rewriting of who is entitled to claim value from whom. This does not mean money is imaginary or that banks can type wealth into existence without limits. The recipient expects to spend the credited balance. Institutions must hold assets, manage liquidity, obey settlement rules, and survive withdrawals. A false entry, insolvent intermediary, blocked account, operational failure, or fraudulent instruction can expose the difference between seeing a number and possessing a final claim. The old broker's strongbox and the modern bank's reserve account perform different roles, but both remind us that payment promises require resources behind them. The deepest economy of long-distance transfer comes from replacing gross movement with trusted coordination. If 100 people send money west, while 90 people send similar value east, shipping every payment separately wastes security, transport, and time. A network can match the flows and move only the remaining difference. The larger and more balanced the network, the more efficiently it can use its cash. But scale also increases the damage one failure can cause, which is why record keeping, supervision, capital, and settlement discipline grow alongside convenience. Fees price the service's speed, safety, reach, currency conversion, verification, local liquidity, operating costs, and default risk. A low price could mean some risk stayed hidden. For ordinary families, however, the abstraction becomes painfully concrete. A worker far from home does not care that economists classify the instruction as a claim and the later reconciliation as settlement. The family needs food, rent, medicine, seed, or school fees. The value of a transfer network lies in making distant earnings locally spendable. That is why informal and formal systems often coexist. People choose among them based on price, speed, access, documentation, trust, legality, and whether an agent exists near the person who must receive cash. Return one final time to the market where you placed 100 silver coins on Hassan's table. Your family has now been paid by Marco. The original silver never needed to leave Hassan's city. Hassan may already have recirculated it locally. Marco's payout came from wealth already in Marco's city. Between the brokers sits a debt that may be cancelled by an opposite payment, absorbed into a trade transaction, assigned to another merchant, or settled later with a smaller movement of assets. To you, the distance has been conquered. To the network, the distance has been converted into accounting. That conversion is one ancestor of the wire transfer. The telegraph did not invent the idea that distant value could be delivered without sending the customer's particular cash. It made the instruction move at electrical speed. Computers did not invent the separation between money and message. They made the ledgers update at enormous scale. Modern banks did not invent trust between distant correspondents. They formalized, regulated, capitalized, and automated it. Before wires, money crossed empires because people built chains of credible obligation. A merchant trusted a broker. The broker trusted a correspondent. The correspondent trusted records, reputation, collateral, future business, or law. Each link converted local cash into a distant claim, then converted the claim back into local cash. The system worked when information was authentic, liquidity was available, and promises were honored. It failed when any of those foundations broke. So the most surprising truth is not that ancient merchants found a clever way to transport coins. It is that the most advanced solution required transporting fewer of them. Roads still carried messengers. Ships still carried goods. Caravans still carried bullion when final balances demanded it. But the customer's payment could be completed through two local cash acts joined by a promise. The customer's particular coins did not make the journey. The recipient received different local coins elsewhere. An instruction crossed the distance. A debt appeared between intermediaries, and trust made that debt usable. That was the economics of sending money before wire transfers. The message crossed the distance, claims and obligations changed. The particular money handed over by the customer did not need to make the journey.